Hello everyone. Welcome to the Daily Commodities and Currencies podcast. Today we will discuss what has happened over the weekend as well as in the last week, and what are the key triggers for this week, and especially in the metals and energy complex. So let's start. Starting with the precious metals first. What we have seen is gold and silver prices given a gap up opening today. We have seen gold prices climbing about $4,400 per ounce in the spot markets in the Asian trading session today, while the precious metal extended their upside with a renewed surge in geopolitical tensions across US and Venezuela. The US has captured the Venezuela president, and the traders are closely monitoring those developments which has happened over the weekend, where we have seen that the US plans to run the Venezuelan country on its own, and market consensus also forecast for the escalation of this geopolitical tensions going ahead in the week. What we can see is because of the escalation of the geopolitical risk, there will be heightened volatility in the precious metals complex in this week. Overall, we see gold extending their upside above $4,400 per ounce levels. Overall, it's also trading at above its 100 and 200-day simple moving averages on the daily charts. So we can expect a strong supports persisting at around 4315 to $4,330 per ounce levels as per the daily charts. And also the prices are broadly expected to trade above its 100 and 200-day moving averages and continuing to trend higher, and bullish buyers would persist as long as prices holds above the same support levels. Now on silver, what we have seen is a sharp recovery towards $76 an ounce in the spot markets today, after the prices went almost to around $70 in the last week. And this is expected that silver may continue its upside in the near term, but there are risks persisting for the silver markets also, because exchanges have raised their margins in the last month. We have seen CME raising margins more than twice in the last month, and if the rally continues, then there is a risk that exchanges across the globe may also move ahead to raise its margins again to contain the volatility in the prices. And also we will see that in the weeks ahead, we will see the US labor markets data taking center stage, where the steady outcome in the labor markets data expected in the non-farm payrolls numbers, which is expected on Friday. And that could also weigh on the sentiments and could keep could lead to some profit booking moves in the bullions complex later in the week. So overall, what we expect is positive momentum in the gold prices in the near term, while a volatility to be expected in silver prices in the medium term perspective. Now let's talk about base metals. Metals have traded in thin volumes due to the Chinese holiday season last week, but kept the positive momentum from the late 2025 levels. Aluminium led the gains, but breaking about $3,000 per ton levels on the LME, while LME copper has risen almost 3%, nearing the last week's peak, just below the $13,000 per ton levels. Fears of potential US tariffs have prompted traders to accelerate shipments into the US, and that has tightened the supply elsewhere. Supply risks have been further highlighted in the last week, where we have seen the strike in Chile against a backdrop of expanding global demand. On the macro side, we have seen that manufacturing PMI numbers from the China remained mixed, while South Korea moved back into expansion, while other nations in the Europe and Germany were slipped, the manufacturing PMI slipped to multi-month lows. So talking about the outlook for the base metals remain supported by strong Asian equities and improving risk sentiment, while supply tightness intensifying due to the capped Chinese smelting capacity and constrained European outlook from high power cost, and demand from the construction and renewables sector still stays resilient. Copper is expected to trade about $13,000 per ton levels in this week, and aluminum about $3,000 per ton levels in the current week. Market focus would now shift to the US labor data, where we could see some steady data coming out in this week, and that could shape the near-term price direction for the base metals complex. Now let's talk about the energy part. Crude oil have traded in a very narrow range last week, on almost a range of $2 per barrel, ranging from last week close to $57.32 per barrel, and up about 1% in the early trade today. market awaits OPEC meeting outcome this week, where on the Saturday, the geopolitical tensions which have escalated from the US and Venezuela side could control with US facing control of the oil producing nation, and that could pull the crude oil markets from their highs. But overall, not much of the impact is seen because of the Venezuela tensions. Oil prices may see headlines driven intraday volatility on this geopolitical concerns, but gains are unlikely to last on a weekly basis. WTI is trading near 57 to 58 dollar per barrel range, and it needs a sustained break above $60 per barrel to turn bullish. We would require directional disruptions from the oil markets to witness any bullish bias in the oil complex for this week. Despite we have seen that overall the global reserves from the Venezuela is expected is very high. Venezuela produces approximately 1% of the global supply. This could limit the near-term prospects of a supply disruption, but US political rhetoric adds a temporary risk premium. It also raises the medium-term risk of supply revival. With OPEC Plus keeping output unchanged through quarter one and global supply exceeding the demand, overall oil remains range-bound with no sustainable upside expected under current conditions. Talking about the currency markets, Indian rupee is likely to remain under pressure this week, with traders warning that a move past 90 dollars, what we have seen in the last week, could spur some dollar demand from importers, while government bonds may fall following higher than expected state debt supply. The rupee had settled at around 90.19 on Friday, were falling almost 0.4% last week, and it had slipped past 90 during the Friday's session. This was despite RBI intervening in the markets by selling dollars from the state-run banks. Underlying dollar demand has continued to weigh on the rupee, keeping the RBI's handling of depreciation pressures firmly in focus, while that is similar to much of the 2025 levels. Overall, for the macro perspective, we have the data lined up this week where US labor data would be in the most focus, as jobs job opening on 7th of January and non-farm payrolls on the 9th of January would be released, as well as the expectation of fiscal year GDP. For preliminary fiscal year GDP from US and India would also be in focus, and that would shape the near-term direction in the commodities complex. So this is all about the commodities update and currencies update for this week. I hope you have gone through these updates, and we wish you a very successful trading week ahead. Thank you very much.